Joining us on Startup Central here on 18 Now. Now, the world's leading VC firm, Sequoia Capital, is warning its portfolio companies that the coronavirus, the outbreak, could usher in a prolonged global economic slowdown and could alter the business environment as we know it. It has asked entrepreneurs to cut down costs, also revise their sales forecasts and conserve cash. We had a chance to speak to the managing director of Sequoia India, Rajan Anandan. Earlier this week, we spoke to him and he gave us insights on this report and also shared his advice for our portfolio companies. Listen in.
The title of for those of you that are interested, the title of the memo is Coronavirus Black Swan of 2020, right? And I think we've all collectively, all over the world, been having a lot of discussions around personally with yourselves, with your families, with your friends, with your team members, how you take care of yourself in light of the virus. You know, everything from, travel less to make sure you're washing hands to don't handshake and so on and so forth. But this was actually not about that. It was about, from a business standpoint, what should founders of startups really be thinking about and what proactive actions should they be considering given in light of the coronavirus. So for those of you who haven't read it, you can, it's a Sequoia blog. But basically, at the core of it, we've started seeing, number one, across many industries, demand softening over the last couple of months, especially the last 6 to 8 weeks. And we think this could be the beginning of something that is not just 2 or 3 months, that could actually go for several quarters. So industries like travel that Deep can talk about, but also across other industries, right? Retail and so on and so forth, because people are just being very, very cautious. Second thing we've started seeing is financing rounds are beginning to slow down, right? So for startups that especially need to be raising financings in the next 30 days, 60 days, 1 or 2 quarters, we think this could be very, very important. And the third thing is, across the board, supply chains are being impacted, right? I mean, you all have written about it and so on. So in that context, if you're startup founders, what should you be thinking about? I think first thing is cash burn, right? If you only have 3 or 6 months of runway, you should assume that in many cases, the business might grow slower than what you had planned, right? Therefore, you may have less runway. So what do you do in that context? I think you've got to really look at every single line item of your expense and think through how you would sort of look at cost in a very different way, right? In many ways, we've been in a growth context for many, many years. I'd say starting sort of the WeWork situation about 6 months ago, that started changing. But we think in light of the coronavirus situation, sales forecasts could be off by a lot. So first is, how much runway do you have, and therefore what do you do? I think second is financing rounds, right? We do think that financing rounds are going to be impacted from a timing standpoint, and therefore, if you're startup founders, how do you think about doubling down, tripling down on monetization, and make sure that the funds that you do have will last, and then to the extent you can raise funding, raise it quickly, because we actually think this could last longer. Third is in terms of how you run the business. We think that sales forecasts are going to become increasingly less reliable, despite of how great your sales teams are, because it's going to be we actually think the predictability of the current environment will continue to change, and being able to forecast becomes very, very important. So as you put all this stuff together, what we're saying is, really take almost a sort of a zero-based look at every assumption that you have in your business, right? What costs you have in your business, how you're driving revenue, how you're looking at forecasts, how you think about funding, and really double down and triple down, because we actually think that, in fact, we were just, 3 of us were having a discussion about this as we were waiting for the session, is our view is this is not a 30-day phenomenon. Right, this is going to be a multi-quarter phenomenon, and 3 quarters in the life of a startup, especially depending on if you're especially a startup that's burning, not generating cash flow, can be pretty large. So we just try to outline a set of very practical, pragmatic actions that we think startup founders should think about.
Sequoia is very, very active in the early stages, and we were talking about how do you kind of gauge whether this company will go on to kind of, track those metrics, which would take it to profitability. I mean, it's a tough one, right?
Yeah, so a couple of things before maybe I comment on that. Look, the type of business determines how profitable that business can get. Okay, so let me use a few examples. So a software as a service company, so let's say a Freshworks, a Druva, iCertis, we have 4 SaaS unicorns now, right? These tend to run very high gross margins, 70, 80% gross margin. Your cost of sales is, call it 20, 30, 35%. Actually, if you want to, let's say, take your growth rate from 200% year on year to 100% year on year, you pretty much break even immediately, right? EdTech companies actually can be very profitable. They tend to be very high gross margin. Your CACs can be in control, and so on and so forth. If you have on the other hand, if you have a business where your average order value is low, you have to subsidize the order to actually get a consumer to buy, and you have to actually build large-scale logistics delivery networks to be able to deliver that product. Then that is a inherently low gross margin business where unit economics are very, very difficult, right? I think what we've seen in India is we've seen quite a number of companies that actually are in the second bucket, right? They're consumer transactional driven businesses with either low or reasonably low average order values, with low gross margin and significant subsidies, right? And in those kinds of businesses, I think what we've started seeing, especially in the last 6 or 8 months, is there's a lot more prudence. Right, so you reduce the subsidy, you try to take your AOV up.
Do you see that consumption sort of drops, and especially keeping all the macro factors in, when you reduce your discounts for businesses which are extremely dependent on discounts to kind of get the consumers in, there will be a perceptible drop, right?
I think the reason a lot of discounting has been happening because of what I call the big battles, right? You have 2 or 3 highly funded companies, each trying to gain significant share, right? So you're trying to outgain, one's trying to gain more share than others. I think what we're seeing now is more of a rationality coming into the market on those kinds of businesses, right? Because capital is getting much more prudent, there's much more focus on unit economics. So I think across industries you're seeing that. Actually, there's a reason why the ride-hailing industry, we don't talk about the ride-hailing industry anymore. It used to lose huge amounts of money. The reason we don't is because it's gotten more rational. Right, so.
But also growth is completely flattened there. I mean, if you look at the discounts.
I mean, no, look, I think in an economy that is growing 4 or 5%, when you have millions of Indians taking rides, growing at 25% is nothing to sneeze at, right? It's just that, yes, it's not growing at 200% year on year. But probably the last thing I'd say, though, is I think it's very important to keep in mind that we always look at a point in time and say, yes, this looks pretty bleak. But you have to keep in mind that of the last 10 unicorns, that became India has about 30 unicorns, right? If you look at the last 10 unicorns, including, let's say, Policy Bazaar, these are businesses actually, by and large, that have very, very strong unit economics, right? Policy Bazaar is basically a consumer internet asset that makes money through lead gen or advertising. Digital advertising is a very high gross margin business. Dream11 is a gaming company, very high gross margin business, right? So actually what we are seeing is, in many ways it's changing. And then now that comes back to, at the very early stages as Sequoia, we're very active. Obviously, Surge was launched a year ago. We don't expect any company to have positive unit economics in day 0, right? But what we're actually looking for is awesome founders that are building companies in industries or spaces where there is the possibility of building a viable economic engine, right? So at a simplistic level, look, if it's an industry where you can make 60, 70, 80% gross margin, you have to try really hard to lose money. I mean, you really have to. I mean, at 70, 80% gross margin, if you're going to have negative 30% contribution margin, man, you have to try really hard. Whereas, if your gross margin is 6%, getting contribution margin, CM1, contribution margin 1 to be 0 is very tough. Right, so what we are really looking at, and that's what we're seeing, actually, it's in many ways an untold industry in India. If you look at some of the sectors that are growing fastest in India at the early stage startups, right? SaaS, new consumer product brands, gaming companies. I mean, these are all businesses, actually, that have very high gross margins.
Rajan, shape up or ship out?
Yeah, I think 2 things, right? One, if you're running an existing business, I think it's very important, I agree with Deep, that you find a viable economic engine, right? Because funding rounds are going to get postponed. It's going to get harder and harder. Your demand is probably going to be not as strong as what you think it is even today. And in that context, you've got to make sure that the cash that you have lasts you a while. And the best way to do that is to actually start generating real revenue with high gross margins, or at least start generating. So that's one. But the other thing to keep in mind is, if you're, some of the best companies in history have been created in very difficult times, right? Sequoia partnered with Cisco right after, in 1987, after Cyber Monday. Google and PayPal made it through after the March 2000 crisis, right? And that's when they really kicked up their revenue engine, which is now obviously extraordinary. Companies like Airbnb and Stripe were actually founded right after the financial crisis. So, because you know what happens is when you're starting up now, it's very real. You know, you are being deeply, you know, you're thinking very, very hard about how to build something that's going to last, to be viable. So if you're an existing founder, I completely startup, I completely agree with Deep. But also if you're starting up, it's actually a great time to be starting up. But you have to start up with the intent to build something that is going to be enduring.
Well, Rajan Anandan, for one, the managing director of Sequoia India, certainly believes that it would be a great time to start. These difficult times present themselves as great opportunities for businesses as well. And of course, you need to rely on funding. How is that picture likely to shape up in these times? That's something that we will discuss after taking a very small break. To stay with us on Startup Central.